Yo, and welcome to this week's edition of Owl Eyes on Base DeFi, the show where we are taking a zero to hero journey, diving into DeFi liquidity pools and how we can be earning yield on the red days and the green days. These are our weekly shows hosted every Wednesday night at 8 p.m. UTC, hosted by yours truly, Basejunkie, and the man with the plan and all the DeFi yield alpha, my homie, Crypto Noah. So without any further ado, guys, if you enjoy these shows, if you've been following along, make sure you smash that retweet button. Let's get this message out to more people as we are looking to provide valuable information in an entertaining way about the murky waters that is DeFi. So without any further ado, let's pass it over to my wonderful co-host, Crypto Noah. How are you today?
Man, I can't complain. Well, I could, but it wouldn't do me any good.
You're looking quite fresh. I'm noticing a bit of a change here.
I haven't shaved my face in over 10 years. I sent it to my mom. She's like, "Oh my God, you look like how you looked in high school." But yeah, no, it's October 1st, doing Sober October. I've been doing this since 2017, so we're in year 8. Got a big group chat. So no, I'm doing good, man. I'm ready to cover some cool base stuff. I got some great news, some exciting news for you guys today on some base DeFi. We're going to look at some yields, and per usual, we got to show the swag. So this is a show from ETH.
100%. This is the real reason why people tune into the show. They want the swag fashion tips.
We're gonna end it right after this because we know this is why you guys are here. This is
we're peaking right now.
Yeah, we're peaking right now. I always try to wear a shirt that like hints on what we're gonna be talking about. And I got this at ETH Denver. You can see it, Lido, ETH. You got Balancer, a few protocols on here showing like the wires that connect the internet. So yeah, I'm excited to get into it, man. How you doing? What merch you rocking today, man?
I'm doing very well, thanks. It's been quite a lovely day. Lots of IRL side missions, keeping me off from what I'm actively working on. But we've actually done a little bit of house hunting, looking for our next rental apartment. Found that today, so that was a big. But hey, in true swag season, today I am wearing my Gladiator tee. I got this from On-Chain Summit. Let me just stand up and show you.
Oh, wait, that's fire, bro.
Yeah.
You got anything on the back of that? Dude, show the back of that thing. Dude, that's badass.
I feel like I'm doing like an Arnie pose.
I didn't even show the back of mine. This is Odos.xyz. Shout out to Odos.
Shout out to Odos. And also shout out to Dan Hendrickson, the CEO and founder of the Gladiators trading card game. It's a trading card game where they are bringing different NFT collections together and basically adding value for multiple projects here directly on Base.
Nice, man. Also, we got to get a shout out to embryo_dolphin_base.eth. We appreciate you always coming on and retweeting and commenting. We do this for you, man, or woman.
Embryo came onto a fireside. She's a lovely lady with enjoys the alpha. So Embryo, this is for you.
We won't let you down, Embryo. I promise. You may be an embryo, but you're gonna walk out of here a fetus. I'm not sure if that's evolutionary makes sense, but we'll run with it.
Let's edit that little corniness out of the show.
Yeah, guys, last thing before we get started, while you're retweeting, tag Base so they can know what we're doing here. We love you too, Embryo. So let's jump into it, man. I want to talk about some cool stuff here. So this is Owl Eyes on Base DeFi, but we also want to make sure you guys are understanding the tech stack and just understanding how this whole thing makes sense. So last week we talked about like why Base exists, right? Why L2s exist, which is to basically help L1s like Ethereum scale, which is basically increasing the transactions per second. Okay. Now, I also talked about how I believe that most applications, and we're already seeing this, are going to be built on the L2s because, they offer faster transactions, which is good for gaming, DeFi, like, getting in and out of liquidity pools, trading and swapping. And, just pretty much if anything can be faster, it's better that way, right? As long as it can be safe. And L2s cover both of that because you get the speed on the L2 and you get the security on the ETH layer 1. So now I want to talk about, hence the shirt, how these things have to go mainstream. And in order to extrapolate or predict that, you have to look at how the internet went mainstream. Okay. So, you know, in the beginning of the internet, like, so right now, for example, we're all on the internet, me and Basejunkie and you guys on stream are like on your phones, and it seems like we're on one internet, but that's actually not true, right? The internet is built on something called TCP/IP, which is short for Transmission Control Protocol, Internet Protocol. And it's the basis of what's called our client server model. So anytime I'm interacting with Basejunkie, it's basically two different servers or multiple different servers that's interacting with each other. On the back end, right? The internet is very much physical infrastructure. It is not wireless. It just seems as if these servers are interacting with each other on the back end. So it looks like we have one experience, right? Now, and this is the key that you have to keep in mind. And the internet went mainstream by companies offering services. When I say companies, companies like Facebook, Amazon, Apple, Microsoft, Equinix, which is the largest server hosting company in probably the world, definitely the United States. They have these server farms where they're hosting all these servers so that we can use them, and it doesn't even seem like we're using them, or we don't know. Because if it weren't for them, and me and Basejunkie wanted to be on the Zoom right now, and you guys wanted to be on here right now, or the stream, you have to have some servers in your house. You have to have fans to keep them cool. Probably hire security because you don't want anyone breaking in and stealing them, right? Your electric bill is going to be out the wazoo. You're going to have firewalls and having to configure shit, right? No one's going to do that, or at least 99.9% of people aren't going to do that. And if they had, we would not be on the internet, guys. Just like if we had to configure our circuit breaker every time we turn on the light, we'd all be using the jack-o'-lanterns, right? So the internet went mainstream from these companies offering these services, and that's exactly what Base is doing with L2s. And they're essentially building on top of TCP/IP. And we're moving into the next layer of the internet, right? It's all a big tech stack, and crypto sits on top of that. The cool thing is you get to own a piece of this new internet, right? Like I said, most of these applications are going to be built on these different L2s, social media platforms, DeFi, NFTs, we're already seeing assets being tokenized and coming on chain, and we have some cool news for you guys about that today. Base just announced at Basecamp 2 weeks ago that they're going to be exploring a network token. So it's just like, imagine if when you were using Instagram, if you were using Facebook, and you were using any internet protocol, even emails, when TCP/IP went public, which they never did, no one owns it, you got to own a piece of the token. That's what Web3 is allowing you to do. So Coinbase, for example, they rebranded their Coinbase wallet to the Base app, and their goal is to combine payments, social media, trading, and mini apps into one unified ecosystem. And they're building this on top of the Base app, which is on top of the original tech stack and TCP/IP that we just told you guys about. So use these protocols so you can own a piece, and just so you can be on the leading edge. And it's not just Coinbase doing these things, but we're going to see all different types of L2s. You know, I think Base is going to be the number one, but it's just helpful to know that the only way that blockchain and Web3 technology is going to go mainstream is if we have companies like Coinbase, etc., building products so that we can use it with ease without having to know what's happening on the back end.
That's an interesting trip down history, and knowing the fact that, you know, Web3 is digital ownership. I mean, like, Web 1 was static pages, Web 2 was writing pages, Web 3 is like digital ownership. There's a smoother.
No, that's it, man. You hit the nail on the hammer.
But yeah, knowing that we can have a piece of this new on-chain economy, yeah, it's. I think that's why we're all in crypto, and especially with this new Base network token coming out, there's been no definitive information for like how exactly to get the airdrop or to qualify for this airdrop. I mean, many people are saying that they're going to be printing between 3.5 to 7 billion dollars. Like is going to launch at that sort of market cap, which by all accounts, this is looking to be the biggest airdrop in crypto history.
I hope so.
So working like providing liquidity, doing stuff with Aerodrome. I mean, Aerodrome is like anything with Aerodrome, anything with Zora. These are some things that have not directly been said, but on-chain footprint matters. And Jesse said it time and time again. Builders will get rewarded, creators will get rewarded. So maximizing your on-chain footprint as much as possible is about as best the information that we have to benefit in this new digital ownership economy, and best qualify yourself for your slice of the pie for this upcoming base token.
Indubitably, sire. I want to talk about one quick thing here that kind of played on what we were just talking about before I get into some crazy news. You guys might have heard it, but go ahead and share my screen here. So basically, Coinbase activates flash blocks. Now, this did come out in July, but it's definitely relevant for today. And it basically slashed the block times to 200 milliseconds. And I think they were down. I think they were like 2 seconds, but now they're down to 200 milliseconds or something like that. So it reduced their block time. And the goal is so that they can continue to attract high frequency trading, gaming, and social media dApps with better performance, basically. So they're making Base faster, right? And they had it on the test net before they made it go live. Right now, the Base app is by invitation only. So I think what they're doing is they're doing all this technical stuff so that once they like release it to the masses, you guys keep in mind, Coinbase has a war chest of billions of dollars. They can get access to celebrities, right? Like once this thing is ready to go and ready to be shipped out, I can imagine that the marketing campaign is going to be crazy. They probably already have ads that they already filmed. So yeah, this is pretty important stuff. So now I want to talk about something that's actually really, really huge. Let me make sure I got my notes here. So Centrifuge launched a tokenized version of the S&P 500 index fund on Coinbase's Base network. Guys, the S&P 500 is basically the top 500 companies in the United States. And the only way to get access to it as of right now is to buy it on your brokerage, and you have to be a US citizen, right? Or at least have some kind of US domiciled fund. There's a high barrier to entry. And the cool thing about tokenization is that it takes that away. Now, there is some red tape around this that we're going to cover, but I'm going to give you guys the high level, and I'm going to talk about how I think this is going to benefit DeFi long term, and how if it was around before the last bear market hit, it wouldn't have been as bearish for sure. Okay. So just to give you the TLDR, it's called SPXA. It's on the Base network. The fund allows round the clock 24/7 trading of the S&P 500 with transparent holdings, and is managed by Janice Henderson and Centrifuge's Anemone. Now, this Janice Henderson has like 500 million in AUM, so they're kind of teaming up. And if we scroll down here, this is the first tokenized index fund licensed by the Dow Jones indices. So when they say licensed, that means they gave it the approval. We all hear about stocks and stuff coming on chain, but if they don't give an approval, then you can't expect any institutional capital to play around with it, right? Now, what is Centrifuge? You're probably wondering, okay, what the heck is Centrifuge? What is that? So I made an in-depth fundamental analysis on Centrifuge like a year ago. I've known about this project for a couple years now. And basically what they do is they allow you to finance different assets and borrow against them, whether it be invoices, mainly illiquid assets, invoices, real estate, even loans, right? You can borrow money against loans. And if we look at this website here, it's called rwa.xyz. They are private credit, right? They're extending credit privately. You can see Centrifuge is just below Maple and a few of the other popular ones we know. They're both Goldfinch. Both of those we also made fundamental analysis videos on as well. So far, they've issued 609 million in loans. Right now, they have 69.5 million in active loans with an average APY of 8.7%. Nothing compared to what me and Basejunkie is getting in DeFi. But for people who aren't allowed in DeFi, institutions that aren't allowed in DeFi, they're licking their chops at yields like this. So if you come onto the Centrifuge website, you can see a few of the funds that they have on chain, right? And a few of the yields. So they have this treasury fund, where it's on-chain treasuries. They have this CLO, which is collateralized loan obligations, 5%. And then this is the fund for the S&P 500. Guys, I did mention that there was red tape on it. And the red tape is that you have to be a U.S. accredited investor, which is basically, have a net worth of $1 million, or not including your primary residence, or make $200,000 a year for the past 2 years, $300K if you include your spouse. And the minimum investment here is $500K. Now, everyone's not going to be able to get into that. It's honestly easier to be able to buy it from like your normal brokerage, but this is the beginning stages. Whenever there's a new technology, a new offering, it's always expensive and kind of inconvenient at first. Like, think about how shitty the internet was when we were using it via dial-up. It was super slow, and it was more expensive than our current Wi-Fi bill. Eventually, regulation and things are going to shake out to where it's cheaper and easier to do things on-chain versus the other. Now, how does this impact DeFi, right? Who cares, really? Like, who cares? So since it's on-chain and it's tokenized, you're probably thinking, well, can I take the tokens and be able to like provide liquidity in DeFi? Like, imagine being able to provide liquidity for the S&P 500. Not quite yet. So technically, token standards do allow you to send assets peer-to-peer, but with most RWA tokens, like these issued by Centrifuge and Maple Finance and Ondo, they use something called whitelisting to basically, they use transfer restrictions on the assets that they're issuing. So basically how it works is you go to that website that I just showed you, where you buy the fund, you prove you're an accredited investor, they do KYC, and then after, you're able to buy a token that represents the actual S&P 500 shares that they hold, right? So they have transfer restrictions at the smart contract level, which means you can only transfer it to another wallet that's passed their compliance checks. So this prevents it from being freely traded like a normal DeFi token. Now, in regards to providing liquidity, in theory, if the protocol whitelists, let's say Uniswap or Aerodrome or even Aave whitelist, like they get some kind of whitelist spot to where they can use it on their platform, and then you can use SPXA as collateral, it could be used in lending markets. So like, imagine, and this is what I said in the beginning, right? If this product was around in the capacity that I'm about to tell you guys right now, we wouldn't have had as steep of a bear market. There's always going to be bear market because it's fear and greed. But if you look at what happened with Celsius and BlockFi and Three Arrows Capital and Terra Luna, it caused a lot of forced selling, meaning people had to sell even though they want to, and didn't want to. And the reason why is because the collateral was tied to what they're investing in. So like, for example, if I'm using Bitcoin or Ethereum as collateral and I'm using it to borrow stable coins and the price of Bitcoin drops, well, I just lost my collateral, and now the platform, when they liquidate me, they're going to have to sell that Bitcoin to get their profit and their fees, right? So when the price of Bitcoin dropped, 50, 60, 70%, the price of ETH dropped 50, 60, 70, 80, 90%, everyone's collateral's value went down and they had to sell, right? So imagine if US Treasuries are on chain, and for example, the S&P 500, you're able to deposit S&P 500 shares or US Treasury shares on Aave and use it as collateral. Now, if you're using it to borrow Bitcoin or stable coins and the price of Bitcoin drops, your collateral isn't going to be faulty because you're using S&P 500, which is something that even if a recession happened, that thing's dropping like 10%, right? Which isn't crazy. It's a huge capital outflow, but it's not that big in terms of percentage drops because institutions are holding it and they're not selling versus like how crypto is right now. So had that happened, it wouldn't have caused forced selling. People wouldn't have gotten liquidated. The market wouldn't have tanked as much as it did. And that's the future where we're heading, where DeFi and TradFi are going to be, they're going to begin integrating, and you're going to be you're going to be able to use like different TradFi assets as collateral and eventually be able to provide liquidity with them in DeFi, right? So this is the long-term vision. But right now we still have a little ways to go. And I think that's pretty huge stuff. It's a good start.
Yeah, 100%. The fact that the S&P actually, greenlit this and licensed this centrifuge operation, this is a huge seal of approval for the whole DeFi market, and it's very exciting to see how that moves forward, especially as you mentioned, getting the institutional backers to invest, because I've seen a few other projects that are doing the tokenized stocks, but actually having the Dow Jones officially give this the seal of approval. I mean, that's huge. I guess my question would be, do you see in the future that rather than doing a pairing against ETH, for example, or USDC, we could one day see ETH paired with the S&P 500 and create liquidity pools there?
Yeah, I mean, the cool thing about DeFi is that, like, a lot of times you'll have seed liquidity pools popping up with the team. They'll take their token, they'll lock it in, and they'll pair it with something so that way it's liquidity, and they don't have to depend on retail liquidity as much. But dude, I can go on Uniswap if I wanted to. I can create a golden, like the golden token that you're holding, golden Chainlink pool if I wanted to. There is no limits to what liquidity pool you can create. Just because there isn't one that exists, you can create any one. So of course, people, ETH and USDC are that's like the bedrock of DeFi, what people transact in the most, and USDT, right? So eventually people are going to take their S&P 500, years into the future when, it's, whitelisted onto Uniswap, or maybe not whitelisted and to where you can like trade it. But they're always going to be some kind of whitelisting, I imagine, just because what happens if you send it to a wallet on accident, you just lost your S&P 500. I mean, I guess that's what happens with your money, right? The dollar is a receipt for gold. If you lose your dollar, you can't get your gold back. So, I mean, there's always going to be gifts and curse. But yeah, we're definitely going to come onto a world where as soon as those tokens are like more free in DeFi and you can take them to a DEX, you better believe people are going to be buying the S&P 500 on chain and providing liquidity for it, for sure.
I mean, for just speaking for myself, I would like to buy some stocks, and I know I'm not a stock trader by any stretch, but I think they say the S&P outperforms the vast majority of people that pick individual stocks. So it is something to look into, diversifying into. I see an interesting question here, and I think I would like to.
Yeah, Rustic Whip. I wanted to touch on that too. Go ahead and read it out.
Okay, so Rustic Whip, you guys are the alpha. Scared to tap into pools because I don't want any chance to lose my Tibber. Hopefully, I'm misunderstanding.
My good brother, you are definitely misunderstanding. So I forget which episode we were talking about this on, but inside of our community, join our community for free. We'll post a link somewhere. It's a link to join our free community. Go to any of my YouTube videos. But basically, man, we teach our students to provide liquidity or manage their portfolio like a market maker, right? And market making and yield farming is the same thing, right? You have these companies will buy stocks and they'll go to platforms like Robinhood and be like, hey, here's some Apple, here's some cash, use it as concentrated liquidity. And then they make trading fees just like we do here in DeFi. Now, if you look at the balance sheet of a market maker, they don't use, let's say they had that same idea with Coinbase stock. I don't want to lose my Coinbase stock. This is what they do. They split their portfolio into 3 different tranches. One is going to be for cash. Cash is good when prices are cheap because you can deploy it at a discount. One is going to be for assets such as Apple or such as Coinbase, such as Tibber, to where when the price goes up, you can sell it for more cash. The third tranche, and I recommend using 25 to 35% of your portfolio once you know what you're doing, is used for market making or yield farming, right? The whole focus on that is staying in range just so you can always be accumulating cash flow into your portfolio, because you never know how much an asset is going to go up or down or consolidate. But the cash flow allows you to always be printing or earning money in that asset so that once it hits your price targets, you're able to sell. So to answer your question, because Tibber is one of my largest holding as well, I called it out back in July when it was a $75 million market cap. Our community is up big on it, over 3x. And we've been accumulating it in the liquidity pools for a while. Proper wallet separation. So you have a wallet where you're hodling your Tibber, right? and you're just, holding it. Hopefully you have your take profit strategy, and when you're getting out before you even got in. And then you have your yield farming section where maybe you're in a Tibber ETH pool or some other liquidity pool, and you're taking the rewards and using those to buy more Tibber. So the Tibber that you want price growth exposure to, don't provide liquidity in that. Keep it separate, but have another portion of your portfolio that you're using for yield farming, so that while you're waiting on Tibber to moon, you're accumulating cash flow so you can buy more, so that when it moons, you'll have more to sell. Hopefully that makes sense, man. You just got to separate that thing out a little bit.
Yes, diversification is key, and I always think it's important to keep some powder dry. As because when those rainy days come, and they do come, having a bit of dry powder to deploy, it's fundamental. But then I've also been caught with my pants down buying the dip. And then when you buy the dip and the dip keeps dipping, it's like, like, okay, I'm just in it. I gotta write it up and then free up a little bit of that sweet dry powder. But look, I would love for us to start looking at some charts, because when we started the series, now this is week 6. This is episode 6 of this DeFi journey. Now, for those of you who remember, who've been with us since the beginning, I started with $1,000, and I went into the Zora WETH pool and a Zora USDC pool. We spoke about that, and many things have happened with Zora, bullish and bearish. Charts be charting. But I exited my Zora position fully, maybe a week, maybe 2 weeks ago. I exited my Zora position fully because I felt there were other opportunities. But I will just pull up the Zora charts, the one that I had, we drew our initial lines on, just to share where we would be and like whether this would still be in range. Okay, so look, this was the original range that we were working with. So for a while, in fact, like we started the show, I mean, now we're in October, so we were like here. So these were like for a while, well within the range, but then recently we were sort of like coming down here. I mean, there was a bit of FUD with the Casanomics scandal, and then as we're coming close to their first unlock, I remember Noah, you shared a website that showed when the Zora unlocks are, and we've seen some more price dipping here. I mean, it says today Zora's up 10%, so maybe it's recovering here. Is this like a forced wick? Who knows? Is it preemptive selling for the unlock? But just feeling the sentiment in the community, knowing we're coming close to unlocks, I exited my Zora position and I switched over to Golden. I'll put it up in a minute. But Noah, you said that you are still in Zora and it's been printing for you. You want to tell us a bit about that?
Absolutely. So, and then Rusted Whip, I commented on the stream because for some reason it would let me comment here, the link to join our free community. And you and I could like book a one-on-one session with me. Go to one of my YouTube videos and just book a link, hit the link in the description. You can book a one-on-one call and we can chat. So anyway, so yeah, going back to this. So yeah, last week we were kind of talking about some, they deleted some accounts on Zora. The market kind of was lagging at the end of down timber, but now we're in October. This is my Zora USDC range. And it originally went out of range a little bit because Zora's been dipping. Now, guys, this is a very, very important thing to keep in mind. Not only are you accumulating fees when you're providing liquidity, but when the prices are down like this, right? And I already put my take profit strategy in my community, so I know exactly when I plan on selling Zora. When the prices are down like this and you're accumulating fees, so like right now in my Zora USDC pool, if I scroll down here, you can see I'm getting 551% APR right now. I literally hopped in. I rebalanced 16 hours ago. I'm a little bit down in principal, right? It was at $4,000, but once it raises, I'm not worried about that. Remember, this portion of my portfolio that I'm using for yield farming, I only care about cash flow, cash flow, cash flow. That's all I care about. I don't care about capital gains appreciation. So I don't care about my principal going up and down. because I'm never going to provide liquidity for any two assets that I'm not holding on their own. So as long as I don't go to zero and I'm still in the game, eventually I'm going to accumulate more fees than my principal, and I'll get to the point to where I'm in a risk-free liquidity pool, right? So in 16 hours, I've been able to make 35 bucks, right? I'm going to refresh this because I had it, I think I refreshed it like 2 hours ago, like before the call. So now I'm at 41 bucks and it's still at 541%. So that's pretty great. Now, the important thing to know is that once you're accumulating and the price is going down, in this fee right here, I'm getting not just transaction fees on each swap, but I'm getting a 0.05% fee is charged on each trade. And that also goes to the liquidity providers. So I'm getting a 0.05% of the entire transaction. Now, if Zora is at $1, right, it's a $100 transaction, I get 0.05% of that. I get that at whatever the price Zora is. So this is almost like, or not almost like, this is exactly like being able to dollar cost average at cheaper prices, because I'm getting those fees at these current prices as well. Remember, you're getting paid in Zora and USDC at whatever the price they are. So 0.5%, like if Zora is $1 and I'm getting a 0.5% plus trading fees, and let's say I'm getting paid $100, right? I'm getting paid $100 at this price. I'm getting paid $100 at this price. I'll get paid $100 at this price if the transaction's happening at this price. So not only does it allow you to get cash flow, but it allows you to lower your buy-in price. Like for the guy who was mentioning Tibber, right now Tibber's at all-time highs, so we're all happy in our community. But when Tibber is down, like it has been, it allows you to accumulate Tibber at a cheaper price so that once it goes up, you have more to sell. So the Zora USDC pool is doing really good. My Zora ETH pool, now here's another thing. I just rearranged this one as well. And this one wasn't out of range. We were around like right here when I rearranged it. But, or actually, no, I'm thinking of my ETH Tibber pool. Never mind. I didn't rearrange this one. So this one is still near the bottom of the range, but I'm just going to leave this one. And this is how I kind of look at rebalancing my pools. If I think that, you have to remember, whatever the first asset is, in this case is Zora, leads the direction of the chart. So if the chart's going up, Zora's doing better than the second one. If the chart's going down, Zora's doing worse than the second one. In this case, ETH. Now, I am expecting ETH to go on a rally this month. If that happens and Zora stays still, we'll start to go down and I'll start to lower my range, right? But I'm still going to give it room. Like even if it starts to drop, I might do one of these and leave the top range the same. And the reason why is because I am expecting Zora to outperform ETH. So I want to give it room to be able to make its way back up, because remember, you make money off of volume, and I want to be able to catch large volume candles. All right. Like when you're providing liquidity, it's kind of like you ever seen that ball where it's like a hidden string, but you're just trying to keep the ball in the middle and you're doing this kind of stuff? That ball is like price, and the strings is like your ranges. So you're just trying to stay in range. If the ball comes up, you kind of raise your hand. If it goes down, you kind of raise it, but you just try to keep it in the middle. Doesn't matter how high or high low, but you just want to keep it inside of your hands. So that way you're always generating yield. And even though the unlocks are happening with Zora here pretty soon, I think the buy-in demand will greatly outpace it. So I want to continue to accumulate it while still giving it range in the pool so that I can make capital gains at the same time as trading fees, but also give it room on the downside so I can be able to accumulate it at those cheaper prices.
That's fair. That's fair. And I think, long term, Zora is going to be one of the winners of the cycle. Time and time again, you just need to look at what the companies that Coinbase Ventures has backing in, and you see those companies, you can quite likely see which ones are going to be net winners for this cycle.
Imagine how crazy Zora is going to go once like the base app. That's like their killer app inside of the base app. Imagine once the base app is ready to go and it's not invite only and anyone can sign up and people start to see Zora and they start marketing it. It's going to be.
Are you in the base app yet?
Not yet. I need to. You got an invite.
Yeah, I have 5 invitations. Everybody who went to Basecamp got 5. So now I have 4 because one's coming your way.
I appreciate it. That'd be great.
But let me show you what I switched out of Zora into. For those of you who've been following my journey, I'm bullish on Golden. Golden is a project that I met at On-Chain Summit. They are looking to tokenize gold. I actually did a short interview with one of their senior team at On-Chain Summit. In essence, it was saying like McKinsey is estimating that there'll be $200 billion of gold tokenized by the year 2030. Currently, Europe is leading the charge, but there's no gold tokenization happening in the US, and they are the ones who are the first movers behind that. They have some serious connections, so I think although they're not really the talk of the town yet, I think they are working quietly in the shadows, working quietly in the back end, and getting deals done. So I feel confident to be putting some of my capital in there. Obviously, this is not financial advice. This is just where I'm choosing to put my capital. But yeah, so here we are. We have last week I had 3 pools. They're all ETH golden.
You got your ranges on the chart so we can see the ranges, or no?
Yeah, let's pull that up. So here we go. Golden.
That thing's still consolidating. That's crazy.
And that's with dollars.
And they still got that same $1 million in liquidity.
Yeah, so look, I don't think that's going anywhere. The only difference I've seen recently is that the volume is less. So with the Zora token, it's transacting like $2 million in volume daily. However, the fees charged were 0.05 and 0.3. On this, the liquidity pool charges 1%. So it's a much higher fee, but that goes straight to the liquidity providers, which in this case is me. So look, from the 19th all the way to the 28th, 9 days of this tight coil. This was crazy tight. So I had three pools going into last week. I had 3 pools. One was to capture this. Like one was super tight. I think it was like plus minus 2% either way. But as you can see, my third pool has gone because with this breakdown in the ETH price, this also led to a breakdown on Golden, and after this wick, it started accumulating at a lower price, and I was like, okay, you know what? Quickly cut my losses on that and pivot it to a wider pool to capture this this volume. So I think this put was probably like my tight range, and then like my other one is basically like that, more or less down here, just below these wicks. This is the hourly. I mean, it's not an old token, so you can see it like, however, but this I claimed this maybe last night, so this is beginning what 24 hours. This is $140 in fees of $3,400 position. It's about what, almost 5% on the day,
give or take.
It's a bit less than I've been receiving daily prior to this. I guess reason being, and by the way, I knew none of this until I started the show. So hats off to you, Noah, for showing me how to navigate these. I honestly, yes. Oh my,
wow. Dude, I want to talk about your strategy. Actually, is you did something that was pretty good.
Okay, well, let me see if I can pull up this this volume charts. So yeah, here we have V4 1% here. I think if I click here, if the page works, here we are. We see the volume. Obviously, you want this volume to be as much as possible. This a higher percentage is wonderful because that means you collect more of the fees. Missing chart data, don't really want to see that. Let me just refresh it one more time, see if it comes good.
While he's refreshing that, the reason why it's 1% is because it's a more risky liquidity pool. So like, the higher the risk, the higher the reward. So whenever you see like more risky pairs, as a trader, you're going to have to pay more because the liquidity providers, they are holding directional risk. Like Golden is fundamentally strong, and I believe everything that he's saying, but to the market, it's not a lot of stuff out there on it. Like you had a conversation with the guy, so you kind of got, you you got a little bit of a treat there. But to the market, it's not really that much information, like what they're holding, etc. So the market deems it more risky. So providing liquidity, holding ETH and golden, it's a higher chance that golden is going to drop to 0 versus USDC. So USDC, the fee will be 0.001 versus here is 1%. They're paying that's a 1% because one, they chose to make that the fee. Like with Uniswap V4 hooks, you can choose your own fee tier. So if I wanted, I can go and create a new golden ETH pool with a 0.1% fee tier. I could do that if I want. But since you're taking the risk of it going to 0, and I say air quotes, I don't think they're going to go to 0, then you're being charged a higher fee, and for taking the risk, you get paid a higher fee as well.
That makes sense. That makes sense.
Yeah.
And also, like, they had, I think this was their launch day. They had, like, big fees. In fact, yeah, this must be the launch day. It feels weird to think it was only like within a month, but since I have been providing liquidity, it's been, I guess, around here. So it's been pretty flat, consistently, what, 2+ K in fees daily. But the past few days have been less. I guess for myself, I need to weigh up whether like if the fees continue to like dry up, then I may reassess the situation and pivot to another token that has higher volume. But right now, this chart has been treating me well. A nice consolidation. This is what I like to see. I mean, and also for the first time this year, providing liquidity, as you mentioned with the bull analogy, like it doesn't matter if it goes up a bit, down a bit, as long as it stays in that range, we're printing here. So,
and it doesn't matter how close it is to the top or bottom, it doesn't change your yield. As long as you're in range, you're getting paid.
Dude, literally look at this. Man, I've been, so this is before I got here, so that's the month. So let's look at like the 19th. So like literally this past week, like literally like tickling the bottom here, maybe out of range for a few minutes, and then up here again, tapping the top, and it's like just coming back down each time. I'm like, yes, good chart.
Sometimes it seems like the chart knows what your ranges is, and it's just like, I'm just gonna be good to him.
I've had too many bumps and bruises this year in crypto. So when this chart's giving me a bit of a, this is the pillow that's keeping me sane. But yes, so $140 in a day from a 3.3K position. I mean, I'm happy with that.
Yeah, man. Yeah, so you're not gonna get that in any savings account. So I wanna talk about like what he's doing, and I made up some mock ranges on my chart just so I can kind of show you guys, and then we'll look at just some overall base yields, and then we'll wrap up after this. So this is probably gonna be the best part of the show. So you guys get ready here. So I'm gonna share my screen. What Basejunkie did is essentially a tranching strategy. It's kind of like going to the ocean and fishing for sharks and little small fish at the same time. And I'll explain why. So I showed this chart a few weeks ago. It shows the value of the cost time in the market versus time in the market. It shows the value of 10K invested into the S&P over a 19-year period, January 2003 to December 2022. If you invested all days, your 10Ks were 64.8K. If you missed the 10 best days, your performance is more than cut in half. In 20 best days, almost cut in half again. And once you miss the 40 best days or more, you actually start to lose money. Now, it's the same thing in DeFi. Remember, you're getting paid off of volume. So you want to be in range when the big candles hit. But remember, Basejunkie made a really, really tight range, because the tighter your range, the higher your yield, but also the higher your risk. And the reason why the risk is higher is because if this green range is my range, it's easier for the market to go out of this green box versus it is to go outside of the blue box, right? So you're always going to be compensated for the risk. Now, this is how you take advantage of being in the tight range pool and getting those extremely high yields, but also being able to take advantage of volume candles such as this one and such as this one, these big candles. You want to tranche it and have multiple ranges set up at the same time. And we teach this in our community, right? So you never know, like if I delete all these candles, you don't know that this is going to be the best volume day and everything else is going to be met with, not as much volume. So what you do is you set it up to get the best of both worlds. Now this is 3 different ranges as an example. So anytime the market's in between the green range, you're making money. It's inside of it. Anytime the market's within this yellow range, you're making money. It's also inside of it. Like you can be inside of multiple ranges at the same time within the same pool. And then anytime it's inside of this blue range, you're also making money, albeit not as much. So now what you do is think about Eskimos. When Eskimos go to do whale hunting, if you catch a whale, you can feed your family for an entire season, right? For an entire winter. You can make gum, you can make, jerky, you can make stew, you can make steaks, you can do all kinds of things, right? And the small fish, they carry you over for a day, albeit they're more abundant, right? You might catch one whale. The whale are these candles. You got 2 whales here that you could have caught, and the rest are just the small fish. But hey, why not catch all of these fish? And the only way you're going to catch all of these fish is to set traps to where you'll be able to catch all of them. For whale hunting, you're going to need a spear and a big net. To catch small fish, you just need a small line, aka a small range, like a small pole with a line, just like a regular fishing pole. So now, the market can be consolidating, right? I don't know how long it's going to consolidate, but boom, I'm catching all these small fish. Let's say it does it one of these, boom, boom. I caught this big move because I have my net for my medium-sized fish. And let's say there's one day where you get one of these, boom, boom, you caught it inside of your net, and then it goes back in here. So while it might go out of range on your green one, your green range, you're going to be rebalancing more often. But in this pool, not so much because it's just been consolidated, and that's good. But your blue range, you're not going to rebalance as much because the market, on normal days isn't going to be that volatile. And then in terms of risk management, the smaller your range, the smaller amount of money that you put in it, so you don't have to suffer as much impermanent loss. So like, let's say you have $100 and you want to spread the $100 out into these 3 different ranges. Here's how I would go about assessing my risk. The blue range, which is the largest one, I'm putting $50 in there. Boom. Because that's where it's not going to pay you the most, but it's the least risky, right? So you put most of your money in that one. So then boom, now inside of this blue range, I'm going to put, let's say, I'm going to put 30% in here, 30 to 35% inside of this one. And then I'm going to put the remaining, what's that, 20%, 20, 25% inside of this. Yeah, 15%. Yeah, sorry. I'm going to put that inside of this green range. And what you'll find is that even though you have less money in this one, or you have more money in the blue one, and then a little bit less in this one, but way less in the green one, when you go to look at your rewards, they're gonna be around the same thing. Meaning, even though you have $50 after a week, you might make $10 in each individual one, because even though it's less money in there, even though it's more money and the yield's less, you compensate because the yield's going to be higher and you have less money, and the yield's going to be much higher in this one with much less money. But since it's way higher, then you're going to make more money. So that's what Basejunkie did. He essentially did a tranching strategy where he had multiple different ones, and this allows you to catch different fish. These are different nets for different fish. You never know when the fish are going to jump, but you always want to have your net in the water if you know they're at least coming, because we are coming upon, what I think is a blow off top.
Yeah. I mean, that's nail on the head. I guess I was tranching without really realizing, but of the 3 and a bit K I had in it, it was about, I think I had 1,000 in the wide range, 1,500 or so in the middle range, because for me, like, it's a very, very tight consolidation. I hadn't seen any like big moves, but you are right. Like, you want to be prepared to catch the big mama jamma wicks. And then I had about $500 in the tight range, and the $500 was paying me the same as the $1,500. The $1,000 wide range was paying the least, and I was like, you know, I mean, I'm a DJ, and I'm like, should I put more into the tight one? But then, I was good for a few days. Really, really nice. In fact, I think I was making 250 to $300 a day. When it was really coiling up like super tight, quarter of a mil in volume daily, and just like on that really tight range, that was printing. But then, just markets happen and it comes out of range, and like very quickly it's like, oh shit, I'm holding 100% Ethereum, and I was like, it was like maybe 0.12, 0.12. I had some fees to collect, and I was like, all right, you know what? I don't know what's happening here with the chart anymore. It's not consolidating in that 1% range. It's starting to move a bit more. It's still within the middle bracket and the wider bracket. Let's just put more into the middle bracket because that seems to be here, and that's the chart I showed you where it's like it tipples at the bottom and tickles the top, but it's behaving for now for me.
Yeah, no, that's good, man. I'm excited to see what it's doing next week. Like I said, you never know when the fish are going to come biting. He can have another week this week like he did last week to where he makes almost 100% APR in 1 week. You just have to show up every day. And in this instance, showing up is passive. You just make sure your net is in the water so that fish can come and set your trap. Like when I look at day trading versus providing liquidity, because I used to do day trading. Day trading is like hunting. Like you're sitting in front of your chart, like you're waiting for things to happen. Providing liquidity is like setting traps, right? You set the trap, and once things go through it, then you catch it, and that's pretty easy. So before we wrap up here, I'm gonna show you guys on our Yield Hunter tool all of the yields that you can get on base across the decentralized exchanges, just so we can see how things are. We are entering to October, which is like historically one of the best months. We're officially in Q4. Q4 and Q1 are the best times for financial markets. So this is just Zora right now. So this is the pool I'm in, 613% APR. Zora ETH pan 301 on average. But if we just look at, I'm just going to delete this and just look at overall base yields. Looks like SUI yields have been going crazy. So Kato wrapped ETH is the top pan. I actually did a fundamental analysis on Kaito. I think that's on my channel. Pretty interesting project. Syndicate. We're going to talk about Syndicate next week. Dude, look at this Syndicate pool, bro. Things pan out over 1,300%. Syndicate USDC and Syndicate ETH both pan out in the thousands. Okay, and they're both, this is a 1% fee tier. Mm-hmm. And Syndicate's not even that risky. And this one's 0.3. So yeah,
I might need to switch over to that because I've been buying Syndicate. Like I've been DCAing down. I got in at like $1.40, and it's like like looking at the price now, it's like RIP me. But I have been rotating my yield into Syndicate, so I think I got something like 46 cents, but my entry price is still over $1. I've been trying to get it as low as possible because I think they will. I mean, they announced yesterday like it will be listed on Coinbase.
Oh, of course, yeah.
But 1,000+%. Was that an Aerodrome or Uniswap?
Let's see. This was Uniswap for the Syndicate USDC, and this is also Uniswap Syndicate wrapped ETH 1%. And this is good because, like you said, you're trying to lower your average buy-in price. Mm-hmm. As Syndicate is like dipping up and down, by you constantly accumulating it, especially when it's down, then that actually lowers your buy-in price. And what you can do is, man, like I was saying, our coach does like this DeFi wedding cake type of strategy where, let's say you're in your golden pool. That wouldn't be a good foundational pool, but like, let's say you're in ETH USDC, right? And you take your rewards and then you put those rewards into a Syndicate ETH. Like this is the next layer of your cake, Syndicate ETH, Syndicate USDC, right? Take those rewards, put them into golden ETH. So like it's almost like you're putting your money through an assembly line. It has to go through 3 different pools. And after it gets out of the top pool, then it makes it to your HODL wallet. You take those rewards and use it to buy something else. And you just kind of got an assembly line going.
Yeah. I hear you there. Just laddering up. I think I think for me, because I'm trying to, I mean, look, it's more risk on because I want to grow the position to have a wider base. Anyway, maybe I should rebalance this.
Well, yeah,
What's your thought there?
So I don't know what your other ranges are, but like you always want to have rules as to what will make you rebalance. Just like you want to have a plan to sell an asset before you buy it, you also want to have a plan to what would make you rebalance before you even get into a pool. And typically what I like to do is if it's out of range for like 6 hours or more, I'll rebalance it.
So here we are. We're getting close to my wider net. It's not actually that wide if you think about it.
You should, after this call, you should like go and put all those marks on the chart so you can see them all at once. So you can see which ranges it's in and which ones it's not, and how close they are and all that stuff.
I'll be honest. I'm holding some syndicate. I'm thinking like, do I want to get into that?
If you don't mind holding it, I mean, I don't see why not. I might hop in it myself.
I mean, that API is pretty crazy. So we've gone to the upside. So okay, I'm 100% in golden at this point.
Next week we're going to talk about syndicate. We're going to talk about the difference between optimistic and ZK rollups and why Coinbase chose to do an OP rollup, and then whatever else. But I'm gonna do a deep dive fundamental analysis on syndicate, and then we're gonna talk about that next week.
All right, man. Well, look, I think after this show, I'm going to open up a small with syndicate pool and leave that running.
Remember, it's on Uniswap. Remember,
Uniswap. All right, I'll see if this bird is ready to fly the nest, and if I can set up the pool by myself. If not, I'll be sliding into your DMs for some tips. But dude, just as we close this out, any final words, calls to action?
Guys, it's Q4. It's time, not just for buying and selling, but for DeFi. People are coming in to mine this gold, so let's sell them the shovels. So if you want to learn how to provide liquidity like a professional market maker, I commented on the link to the stream. It says join our free community. You can hit that link. We also have 3 DeFi webinars that we do virtually every week. RSVP for one of those, you get the whole picture. And then we'll show you guys all of our memberships. We're transferring our domain name right now. So knowitals.xyz is our website. But like I said, we're transferring that. So next week it should be up and ready. But yeah, join our free community, RSVP for one of our webinars. If you want to book a one-on-one call just to see how everything would be a good fit for you, you're more than welcome to do that as well. It's in any of the video descriptions on any of my videos or the Know It Owls videos. But that's pretty much it. Let's lock in. It's Q4.
That's it. It's lock-in season. Rectember's behind us. Now it is October, so position yourselves accordingly. Use risk management. Obviously, do your own research, but Noah, with your community, I appreciate the guidance and advice that you are giving to myself and other DeFi newbies who are looking to upskill and tap into this part of crypto. It's been the only thing that's been generating money for me as the markets have been dipping. So definitely excited to continue this journey and talk more about the syndicate pool next week and dive deeper down the rabbit hole with DeFi. So yeah, appreciate your time. I appreciate everybody who tuned in today. And yeah, again, we host these shows every Wednesday night, 8 p.m. UTC, where we discuss DeFi, yield strategies. And if you have questions, make sure you jump in the comments. Thank you, Rusty Whip and Embryo Dolphin, for your questions and insights today. We hope you've found this informative. So until next time, stay safe, stay healthy, most importantly,
stay blessed. Peace out.
Peace out, everyone.